we detected an unusual trade worth $24 million on Coinbase stock, ticker symbol COIN. But here's what makes this even more interesting. Because Coinbase is correlated with Bitcoin prices and Bitcoin has been dropping, the stock has pulled back sharply, falling from its 52-week high of around $444 to about $255. That's around a 40% drop. So the big question is this a buy the dip opportunity or will the stock crash lower? According to technical analysis, the stock is on a downtrend, which could signal more selling pressure and downside ahead if the trend continues. As they say, the trend is your friend. But it could also bounce back up as investors see the lower share price as a chance to buy in. That's why technical analysis can often be confusing. And that's exactly why we also look at the data to see what smart, wealthy investors are actually doing with their money. So in this video, we'll break down this unusual option activity to figure out whether this wealthy investor is bullish in buying, expecting the stock to bounce back up, or bearish in selling, expecting the stock to drop lower. Because as we all know, the rich have more access to exclusive research and information, sometimes even leaked insider information, giving them an edge to make better, smarter financial decisions. This is how smart money always stays one step ahead, well before the rest of the market catches on. No wonder the rich get richer. And so, to level the playing field, let's dive into the unusual option activity to gain insights from the rich so that our subscribers and members can profit from this deep knowledge too. As we can see here on the options time and sales tape, there was unusual option activity on November 24th at 11:24 a.m. at the 52-second mark in these December 19 options at the 260 strike calls and the 310 strike calls. A quantity of 16,805 contracts were being traded in both of these options. Now, at first glance, this trade looks like a vertical call spread being opened. But based on our deeper analysis, this wealthy investor was actually closing out of these 310 strike calls and rolling down to a lower strike price into these 260 strike calls. This means that these December 19 options at the 260 strike calls are the new opening trade. And these contracts were being traded at a price of $14.40 each. So we can calculate the total cost of this new trade by multiplying the number of contracts traded by this price per contract. But remember, options are priced per share, and each options contract controls 100 shares of stock. So to get the actual dollar value, we multiply by 100 or simply move the decimal 2 places to the right. That means each of these contracts cost $1,440. And so when we multiply this by the quantity of contracts traded, 16,805, this equals a total trade cost of approximately $24 million for this unusual option activity. But keep in mind, just because a trade is large does not necessarily mean it has a high probability of success. In fact, this one carries more risk than the smaller, more selective trades we share on our website. And so if you want to get access to those lower risk trades with a higher probability of profit, then go to our website. We'll link it up here. And if you join the membership through our website instead of YouTube, you'll also receive additional trade alerts by email because YouTube does not share your email address with us. So if you want more opportunities to profit, make sure to join the membership through our website. Keep in mind that our members also get earlier access to trades like this before anyone else, even before we share it with the public. So if you're tired of being late and want more time to act on these opportunities, just head over to our website, where you can see exactly which stocks wealthy investors are trading on Wall Street and when they're doing it, so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? With that said, even though this trade carries higher risk, we still took it, but we used position sizing to manage our risk. Now, how did we know these 260 strike calls were opening trades and the 310 strike calls were closing trades? Because if a wealthy investor is closing out contracts or trades, it could mean they're worried about that position. So maybe it's not the right time for us to jump in since they're getting out of the trade. On the other hand, if a wealthy investor is opening new contracts, it could signal an opportunity for us to start a new trade. This data is very important to confirm because it strengthens our analysis and that in turn increases our probability of profit. So let's check the data on the option chain for the December 19 options at the 260 strike calls and the 310 strike calls. And we can see here at the 260 strike calls, the open interest is over 17,000 contracts opened here, which is higher than the 16,805 contracts that just traded. This tells us that this wealthy investor opened new positions here because the open interest increased. But at the 310 strike calls, the open interest is only about 9,000 open contracts here, much lower than the 16,805 contracts traded. This means these contracts were closed out and reopened at the 260 strike calls using an options rolling strategy. And that is why we entered the same position here, marked as POS, with the green color indicating a buy position at the 260 strike calls. Now, keep in mind, some of these new contracts could be other traders jumping in as well, including our members and even us, which is why the number of open contracts is slightly above 16,805. But the majority of these contracts were opened by this wealthy investor we've been tracking, the one who bought these 260 strike calls at a price of $14.40 per contract, the same price as we saw earlier on the options time and sales tape. And so when we analyze this trade, we can see here on the risk profile graph where the profit or loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line over here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below the zero break-even line, as the share price goes down, this trade becomes more negative, more loss. And as the share price goes up, this trade becomes more positive, more profitable. In other words, this trade is going long bullish on Coinbase stock. We can also confirm that by checking the options Greeks. This trade has a positive delta, which means it's positioned long and bullish. If it was a short bearish trade, we would see a negative delta instead. But keep in mind the risk with this trade. It has a negative theta, which means it loses value over time due to time decay. And that is why you can see here, the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break-even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $260, the stock needs to trade above $274 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We do not invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here where you can also learn more strategies to increase your profits. Let us know in the comments, do you think Coinbase stock will move higher or drop lower? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.